Hello traders, Gary Wagner here, just before 11 o'clock in Honolulu, 4 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands, 15th day of January 2016, and this is the daily report for gold and silver, our weekend review. We are combining this with trending markets because these markets are so interrelated that the weekend review really needs to encompass all of the aspects of all of the markets. Gold, tremendous upside move today, up about $11 at 1089. Now, the reason I say tremendous is the market has been under such dramatic pressure as it's come off of some recent lows at around 1045. So the fact that we're back above 1080, that is very, very significant to me. The fact that we've got crude oil continuing to fall and the equities markets in a virtual tumble today. These are all things we're going to want to take a look at on today's daily report. Also, when we take a look at silver, silver is up, but in terms of the percentage gain, as you can see, it's trading up about 7 cents, still below $14 per ounce, and up about 0.5%. When you compare that, of course, to gold, gold is trading up over 1% on the day, so you can see quite a difference. First chart that I do want to take a look at today is going to be a simple bar chart. This is a daily bar chart. We looked at this yesterday, but I think what is important about this particular chart and the areas within this chart are really the current levels of support as well as resistance. In fact, let's go ahead and convert this back to a candlestick chart. And so traders, we've done just that. We've converted back to a candlestick chart. On this chart, two basic fib retracements, one going from 1191 down to about 1046, and you can see our 50, 38 and 23% retracements on the left-hand side. On the right-hand side, we have one fib retracement, which begins roughly from 1045 and tracks up to 1113. Now, 1113 was the high of this most recent rally. Now, when we do that, we get different levels. And of course, we talked about a critical level yesterday, which is a 61% retracement of this smaller move. In other words, that's just this move right in here of this smaller move. A 61% retracement, of course, really matched up 1071 to the low that we saw yesterday in the market. Of course, where I believe we have critical areas that need to be taken out, which in fact were taken out today, was 1080. Now 1080 does come in as a Fibonacci harmonics, and what I mean by a harmonics is that when we look at two different price cycles, this price cycle here from 1191 down to 1046, and then this price cycle here from 1113 down to 1046, and we get a area which gives us the same information or the same conclusion. That's a harmonic. So whereas we've got a 23% retracement right in here at 1080, we also get a 50% retracement at, call it 1080, I believe it's 1079.73. So we can see that that is absolutely a pretty important level, and we certainly took that out today. The second thing that is noteworthy in the market today, besides closing and trading above what we deemed as some pretty critical levels, and in this case it was a critical level of resistance, it was former support, and I believe now will regain its status as support. We did get what was called a piercing line. Now, in terms of the piercing line, this is a very, very strong example of that pattern, because simply put, after a defined downtrend, we met that criteria. You have a long red candle, and then you get a market which opens at or below the prior candle, which is this open here matching this close here, and closes at or above the midpoint of the prior candle. Now I'm just guessing on this, or estimating, it's not really a guess, but estimating that that's approximately our midpoint. So we have closed well above the midpoint. If it closed much higher than this, we would have had what is called an engulfing bullish pattern. And of course, on the engulfing bullish pattern, as well as the piercing line pattern, we're going to wait for confirmation. Now, the markets are closed on Monday due to Martin Luther King Day, but they will be open on Sunday as it trades overseas. So this is what I'm looking at, and this will represent a trade alert that comes out that is contingent upon, it's a conditional trade alert, contingent upon receiving a confirming candle to today's piercing line pattern that would look something like this. This is how the pattern would unfold. Now realize, this obviously is just for example's sake, but you would get a green candle with a higher high and a higher low. The closer it came to closing above these tops right in here, which to me is more important than these highs, but if it were to close above these tops, that's strong. To close above these highs here, that's even stronger. So I am going to issue a conditional trade alert as long as we get a confirming candle. Traders, this is the time we do want to re-enter the market and re-enter it from the long side. We've seen this market bottom out at these particular areas of about 1045, and we've seen it really fight to utilize this particular area, meaning 1080, as a critical area. And you can see how it was absolutely an area of resistance. As the market came down and tried to come back up, it could not exceed it. It attempted on a number of occasions, but it wasn't until this most recent rally that really began at the beginning of January that we were actually able to A, have a higher low than the previous lows, and B, to take out this 1080. Now that was to be short-lived because the market came up, tested these highs at 1113, came back down, and on this particular sweep down, it held at a 61% retracement. So that to me is a pretty solid indication that we will probably see a gold start to trade higher. I would look for some sort of a rally to develop here, but as I said, that is our conditional trade alert. So traders, no doubt about it, there are two precipitating factors to seeing not only gold trade higher, but equities trade under pressure. And in two words, they are China and crude oil. China, and in terms of their economy slowing down, in terms of their equities markets being under pressure. The fact of the matter is their consumption of oil has dropped. When we look at the price of crude as it trades today, losing another 5% on the day, but below $30 at $29.64. Now, this is a chart that we have looked at over the last couple of trading weeks because it gives us a very, very clear picture of not only where the market is, but where the market's been. We talked about the fact that $33, this was that really important mark in terms of a low right in here, because that matches the low that came in after the meltdown in 2008, 2009. You can see that in 2008, oil was as high as $150 per barrel, almost just shy of 150, and by the beginning of 2009 had dropped all the way down precipitously to about $33 per ounce. So traders, all I have really done is added a single horizontal line, that's this blue line here, and pegged it to the lows that we achieved roughly at 29.42, because in that way, by compressing this chart, obviously we can take a look to see the last time oil has traded to this price point. That's this blue line here. When we do that, we have to go back to 2003. The end of 2003 was the last time that crude oil was trading at this particular price point, and that would be right in here, the last quarter of 2003. So traders, when we consider that gold in terms of pricing has gained about 1%, crude oil has lost 5%, and this, we're talking daily totals. When we take a look at the U.S. equities markets plunging today under tremendous pressure, although closing off of the lows, we did get the Dow Jones Industrial Average closing below 16,000 first time this year, but off about 390 points or 2.39% lower on the day. Tremendous sell-off in the equities markets. We can really see that when we look at the Standard & Poor's. This, of course, is the E-mini, now at 1878. 1879, off 1.88% or 35 points, 36 points lower on the day. Couple of things. First, we did send out, although it seems to be an extremely moot point, a trade alert, and this, of course, was a trade alert that was contingent upon certain actions within the market. We'll talk about that right now. What we were looking at, we had a dynamic reversal yesterday. We're back to the same today, but as this market came down, of course, we had really what was called a bullish harami. It's an inside trading day where it opens inside the prior range of the prior candle, meaning the day before that. So this would be Thursday. So it opens really above the close of Wednesday, but it closes below the open of Wednesday. So it's an inside trading day. And we were looking at the fact that if we got confirmation on today's trading, which would have been in essence a green candle with a higher high and a higher low, and we also pegged the price of about 1920, which we obviously never got close to, and it would have looked something like this. It would have been a green candle, so you would have had green and green. That would have really met the criteria. Of course, we absolutely did not meet the criteria, and so no trade were executed. But what that does is it puts this market in an extremely precarious place. It did, and this is what is important, it did close above 1860, because when we look at this market in terms of historical perspective, under pressure, we have to note that this is a very, very important particular level. And of course, the August meltdown lows that came in end of August, beginning of September of last year, and those come in roughly at about 1830. So these are the two areas that we're genuinely concerned with. Now, we did trade through this particular price point. You can see that right here, but we closed dramatically above that particular price point. We didn't go to capture anything near the area of 1830. You can see these lows coming in the 18, call it 50 range. And so the question is, will the market be able to find some sort of support, or is it likely that it will come down and test these most recent lows? Now, we have a holiday on Monday, Martin Luther King Day, so these markets will be closed. We will have markets trading and reacting, of course, overseas in China. Sunday in the mainland, as well as Hawaii, will translate, of course, into Monday in Asia. And that's going to be a very, very interesting day, because we'll see if the market continues to slide and continues to put dramatic pressure on global equity markets. So traders, we are looking at the E-mini as it trades globally on a intraday chart that is broken up into half-hour candles. Beginning of the trading day starts here. Of course, this would be overseas in our futures markets, but it trades quietly until dropping fairly heavily down to about 1860, rises to about 1880, but then, as you can see, we get this precipitous open in the United States, in which the market plunged down to 1848, so about 1849 in terms of a low, and absolutely came up off the lows, really, and this is our close right here, to close very much off the lows, closer to the highs, but still under tremendous pressure. In terms of what we're looking at, as I said, Monday is a holiday here, but we have a contingent trade alert, which we're going to issue in gold. We talked about that in detail at the beginning of the program. In terms of the equities markets, I have been looking for a potential bottom for the market. We certainly haven't seen anything even close to that. And we'll have to see how the dust settles and where these equities want to go into the second half of the first month of 2016. What a way to start the year. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you next week for another daily update and reviews in both the gold forecast and trending markets. Bye-bye.